Here's something that sounds impossible, but it's completely real. When you borrow £10,000 from a bank, the bank doesn't usually move £10,000 from someone else's account into yours. Instead, it creates a brand new £10,000 deposit. Just creates it. And this isn't some conspiracy theory. This is how the Bank of England, the European Central Bank, and the Bundesbank all describe the system. And it affects everything from why your rent keeps rising to why interest rates suddenly matter to your mortgage. Let's look under the bonnet. So if banks can just create money when they lend, where does that money actually come from? Did they just type it into existence? If that's true, why can't they do it forever? And here's the really strange part. What happens to that money when you pay the loan back? These aren't abstract questions. The answers explain why house prices have risen faster than wages for decades, why debt levels keep growing, and why the whole economy seems to speed up or slow down based on how much banks are willing to lend. Most people were never taught this, not in school, not even in basic economics classes. But once you see it, you can't unsee it. Here's what most of us learned, either in school or just by assumption. Banks take money from savers, people depositing their paychecks, and lend that money out to borrowers. So if you deposit £1,000, the bank might lend £900 of that to someone else. Your money funds their loan. Simple. That story makes sense. It feels safe. It's tidy. And for most of history, that's more or less how banking worked. But in the modern economy, that's not the main story anymore. The Bank of England put it bluntly in a 2014 paper. Banks do not simply act as intermediaries, lending out deposits that savers place with them. So what are they doing instead? Let's use a simple example. You walk into a bank and take out a £10,000 loan to buy a car. Here's what actually happens. Before the loan, the bank has its existing balance sheet, assets, old loans, reserves, securities, liabilities, customer deposits, other funding. After approving your loan, two things happen at once. The bank creates a £10,000 loan asset on its books. That's you owing them money. And simultaneously, the bank credits your account with a £10,000 deposit. Let's be clear about what just happened. Bank's assets, plus £10,000 the loan to you, bank's liabilities, plus £10,000 the deposit it owes you. Both sides of the bank's balance sheet got bigger. Now look at your balance sheet. Your assets, plus £10,000 deposit in your account. Your liabilities, plus £10,000 debt to the bank. Here's the key. That £10,000 deposit is new. It didn't come from someone else's account. The bank didn't pull it out of a vault. It was created the moment the loan was approved. The Bundesbank describes exactly this process. The ECB says it plainly. When a commercial bank grants a loan, it creates money. This sounds like magic, but it's just accounting. Now you might be thinking, okay, but that's just numbers on a screen. That's not real money. But here's the thing. For you, that deposit is money. You can spend it. You can transfer it. You can buy a car with it. To you, it works exactly like money. And that's because most of the money people use in everyday life is bank deposits. The ECB says commercial bank money, meaning deposits at private banks, makes up most of the money people actually use. Physical cash? That's only a tiny fraction. So when the bank creates a deposit, it has created new commercial bank money, money that didn't exist a moment ago and now does. All right, so you've got £10,000 in your account. Now you buy the car. Two things can happen here, and they're slightly different. Scenario one, the car seller also banks at the same bank as you. In that case, the deposit just moves from your account to theirs. Inside the same bank. No money leaves. The bank's total deposit liabilities stay the same. Scenario two, the car seller banks somewhere else. Now it gets more interesting. Your bank has to settle with the seller's bank. To do that, your bank transfers reserves, a type of money that only banks use between themselves, to the other bank. Reserves are held at the central bank. They're like the bank's bank account. So your bank loses reserves when that deposit leaves. And this is important. Reserves matter after the loan is made, not before. The bank didn't need to have reserves sitting there before it made your loan. But once you spend the money, it might need reserves to settle the payment. Now let's fast forward. You've had the car for a while. You're paying back the loan bit by bit. Each month you transfer money from your account to repay part of the principal. Here's where it gets strange again. When you repay the loan, That deposit money disappears. The ECB says it clearly. When you repay the loan, the money created disappears. Why? Because the bank reduces the loan asset on its balance sheet, and at the same time it removes the deposit you used to repay it. Both sides shrink. The money that was created when you borrowed is now destroyed when you repay. Think about that. Money isn't just printed and then around forever. In this system, money is constantly being created through new lending and destroyed through repayment. The money supply expands and contracts with the credit cycle. Okay, here's the obvious question. If banks can create money just by making loans, why don't they do it infinitely? Great question. And this is where the limits show up. First, capital requirements. Banks must hold a certain amount of capital, money they actually own, relative to their risky assets. If they lend too much, they run out of capital cushion and regulators step in. Second, liquidity. Remember when the deposit left the bank and they had to settle with reserves? If a bank creates too many deposits and they all flow out, the bank can run short of liquid assets. That's dangerous. Third, risk. Every loan is a risk. The borrower might not pay it back. Banks won't lend to just anyone because defaults hurt their balance sheet and wipe out capital. Fourth, borrower demand. You can't create a loan unless someone actually wants to borrow, and people only want to borrow when they think they can afford to repay, or when the economy feels stable, or when interest rates are low enough. Fifth, central bank interest rates. When the central bank raises rates, borrowing becomes more expensive. Loan demand falls. When rates drop, borrowing picks up. The Bundesbank explains it well. Lending is constrained by liquidity and especially by capital standards. So no, banks can't print infinite money, but they do create a lot of it within limits. This isn't just theory. This mechanism shapes your everyday life. Let's talk about housing. Every time a bank approves a mortgage, it creates a new deposit. That deposit gets spent on a house. And when lots of banks approve lots of mortgages, lots of new deposit money flows into the housing market. More money chasing the same houses? Prices go up. This is part of why UK house prices have risen so much faster than wages. It's not just supply and demand for houses, it's also supply and demand for credit. When credit is cheap and easy, deposit money expands, and a lot of it flows into property. When banks tighten lending standards, like after the 2008 financial crisis, money creation slows. House price growth slows. Or reverses. Now let's talk about debt cycles. Because lending creates money and repayment destroys it, the total amount of money in the economy is closely tied to how much debt is growing or shrinking. In a boom, people and businesses borrow more. Banks create more deposits, the money supply expands, spending rises. In a bust, people repay debt faster than they borrow. Deposits are destroyed faster than they're created. The money supply contracts, spending falls. That's why debt matters so much. It's not just a personal burden. It's part of the mechanism that determines how much spendable money exists. And interest rates? When the Bank of England raises rates, borrowing gets more expensive. Loan demand drops. Less lending means less deposit creation. Money growth slows. That's how central banks cool down inflation. Not by printing less cash, there was hardly any cash to begin with. By making credit more expensive, so banks create fewer deposits. Let me give you a current example. In January 2026, UK banks lent £10.5 billion to the private sector. In that same month, households increased their deposit holdings by £4.2 billion. Not one for one, but they move together. Lending drives money growth. Here's the simple rule you can take away. Loans create deposits. Repayments destroy them. That's the core of how money works in a modern economy. Banks don't just store money. They don't just shuffle existing money from savers to borrowers. They help create most of the money people actually use by expanding their balance sheets when they lend. And that money disappears when those balance sheets shrink. So when you hear that the money supply went up or down, now you know what's probably happening behind the scenes. The total amount of bank lending is changing. This is one of those things that once you understand it, the economy starts to make more sense. Why do house prices seem disconnected from wages? Partly because they're driven by credit creation, not just incomes. Why do interest rates affect everything? because they shape how much new deposit money gets created through lending. Why does debt matter so much? Because in this system, debt isn't just a side effect of spending. It's tied to the creation and destruction of money itself. Banks aren't omnipotent. They're constrained by regulation, by risk, by capital, by demand. But within those limits, they play a central role in determining how much money exists, and that affects all of us. So here's my question for you. Before watching this, did you think banks were just lending out other people's deposits? Let me know in the comments. I'm curious how many of us were taught the old story. And if this changed how you see the economy, share it. Most people have no idea how this actually works. Thanks for watching.